Good day, traders. I'm Stacey Burke from Stacey Burke Trading, and today we're going to be just doing a quick review on managing your risk and keeping your risk constant. So one of the things I did while I was away was I spent a bit of time reviewing the Turtles principles in terms of how they manage their risk and their unit exposure regardless of the instrument they were trading. And so one of the things that they talk about is using the volatility of each instrument to give them an idea of how to calculate their risk and their position sizing. So just going to use an example, a spreadsheet that I use to not only determine position sizing based on a certain percentage of risk, but also the conversion of the currency, because each currency is different. My account is in Australian dollars, and so therefore when I take trades on different instruments, that dollar or pip amount can be different for every instrument. So even though I think I might be taking a maximum position sizing risk based on my technical stop on pips, the actual conversion of the pip to the Australian dollar might be more than $1 a pip or $10 a pip or 10 cents a pip, depending on the size of position that I'm taking or you're taking. So just giving you an idea, what I do at the end of each week or on the weekend as I go back through and I check the volatility, the 20-day ATR for each instrument. So what I do is I enter that manually, and that's just quite an easy thing. If you wanted to just look at your ATR, which is one of the indicators up in the MetaTrader charts. I'm sure regardless of how you're trading, average true range is probably in every trading platform. So what I'll do is I'll tend to go to the end of the week, our Friday bar, and I'll just look at that, and that tells me that the ATR for the last 20 days, the average true range of the last 20 days is 98 pips for the euro. So I'll go back here. Sorry, we'll just double check that. Sorry, on Friday when I checked it, it was 98. So I'll go back to my spreadsheet and I'll punch in 98. So then as you can see, immediately that calculates based on an account size of $5,000, let's say, at a 0.5% risk per trade. That's just what I've put in. You can use whatever percentage terms you want. But that's based on the pip value and that maximum 0.5% risk on each trade. So if I'm going to risk 0.5% of my capital on each trade, the next step that I need to do is to figure out what my conversion rate is for that instrument. So I actually just use a site online called fxpro.co.uk, and I actually have downloaded their Google tool that I can just put in. So I put in euro, my account is in Aussie dollars, and it gives me just a lot size, a mini, mini lot size, but it's irrelevant. I'm just looking at the pip value, which is $1.28. So we'll put in 1.2875 into our spreadsheet, which it rounds out to 1.29, and then therefore it will divide that into the $25, which was our 0.5% exposure, and then divided by 98 pips is our maximum amount of technical stop. So it's going to allow me to trade based on that size, 2 micro lots. So in this particular instance, for a $25 stop loss, 2 micro lots would be the amount allocated to that particular trade. Now, for example, if you're day trading and you had a 12 pip stop, it would allow you to trade 16 micro lots or 1.6 minis. Now, based on that account size. So, however, again, you can adjust that risk yourself, but it's important that if you are using a different account than US dollars, that you understand that the conversion rate will be different, and therefore you can figure out the whole point of this is that 1R, no matter which instrument gets traded, one our stop is the same. As you can see, the maximum risk is the same on every position. And so the point of that is that we can keep our losses constant. Our profits are unpredictable. We don't know what the markets are going to do. You might get half R profit. At some point you might exit a trade at half R. You might get 5R. You might get 10R. But we know that at the end of the day, if we can keep our losses constant, meaning 1R, and that's where this currency conversion is, the maximum stop loss, and then your maximum account dollar value per trade, it gives you the number of contracts that you can trade to keep that 1R constant. So again, I just use fxpro.co.uk. Again, you can use it online, or in what I've done, you can do it on your phone as well. You can download their app, but I just use their little Google tool here to figure out my Pip values, which I only do on a weekly basis. It takes me 10 minutes to fill this sheet in, and then I'm ready for the week. So if I have a long order, we might say, let's say the euro today, we decided to go long, and at the close of the market we went at 23.40 with the spread, 1.2340. I like to get an automatic, it tells me the maximum stop loss based on that pip. So actually in this particular case, our stop loss would be at 22.68. So it's actually 32 and 72 pips instead of the 98. So we'll actually take the smaller of the two numbers, and you can see in that particular case it bumps it up and allows me to trade a few more micro lots, and still have the same amount of exposure. It gives me that's the maximum stop based on that the amount that we put in from that one candle, and that's a minimum 2-to-1 target. So I know at 24.84, if the market was to go up to that level, that's the minimum of 2-to-1. Now, the market may not get there, but I do know that that's what if we were to enter the market in long at that point, that's where we would be looking to see the market either fail or leave a target in there if the market was two-sided on the way to that higher end. But if this was an explosive move, I'd be prepared to trail that or set a target maybe again as an expansion of this range. This isn't a trade setup, I'm just using that as an example. But again, as soon as I put in that data, the market, it just gives me a minimum 2-to-1 so that I know that I have an asymmetrical risk reward, and I need to look at that technically to see if there's some level of significance, which we can see there is. We potentially may see some resistance up there. We've already seen the market turn off of that twice. Now again, that's not an actual trade setup. I'm just using that as an example to demonstrate the spreadsheet. But the most important thing I'm trying to emphasize is that regardless of the technical stop size, you need to understand your account conversion pip value, and then whatever your maximum risk is per trade, that it's constant based on that with that conversion, and that pip size, the number of contracts therefore is allocated to keep your losses constant. And that's really critical as a retail trader. If you can focus on managing your losses, keeping them constant, the upside when you're in the winning trades, therefore you can start to look at getting some kind of asymmetrical expectancy, whether it's 1.5, 1.7, 4.2, but we know that 1R is 1R with your losses. So hopefully you got some value from today's video, traders. This is just a simple spreadsheet I've punched in myself, pretty straightforward. Hopefully you got some value from that, and keep it simple. But the most important part is to definitely keep your losses constant. And again, that website fxpro.co.uk, but there's other ones out there, and I just use that tool on my my Google calendar, my Google browser. So keep it simple, traders, and manage the downside. Have a great trading week, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments, As always, traders, stay disciplined and may the markets go with you.